Hey everyone, thanks for joining us for this latest installment of News Digest, brought to you by Masters of Supply Chain. I'm joined today by a friend of ours, friend of Masters of Supply Chain, and an economist who spends a lot of time thinking about the impact of what's going on in the world on supply chains in particular. Walter Kemmsies joins us. Walter is the managing partner of the Kemmsies Group. And Walter, great to see you again. Thanks for spending a little time with us this afternoon.
Yeah, John, it's great to see you again.
Yeah, so Walter, it strikes me. Matter of fact, I remember the time we were. If we would have had this discussion 8 months ago, the world was really focused on ability to ship, risk mitigation on things like, is there going to be strife that keeps me from being able to get out of Taiwan through the South China Sea? Is turmoil in the Middle East going to give me some drama around the Suez Canal? How should I think about those things? I would imagine that a lot of your world lately, and certainly the last 7 months, has been, what do we do about these tariffs? And I think all of us saw the deer in the headlights moment that people experienced, followed by, okay, maybe this isn't about protecting what we got, but rather what is the new normal and how do we get to what that looks like? I would imagine you're spending a lot of time with clients and trying to understand what that is. Is there anything that sort of you've been able to divine, and how are you approaching this?
Yeah, it was, well, I'm going to take a little step back, John. Just
Yeah,
we went through COVID, and as we went through COVID, all of the Wall Street guys, the stock analysts and the board members harassed the C-level executives at major importers and exporters about their supply chains. They were struggling. In the fourth quarter holiday sales, for the retailers, they couldn't get their stuff into the U.S. fast enough
right.
to sell. I mean, I remember February of 2021, the Halloween merchandise that was due, in September, that was finally coming off the ships. It was really bad. And some retailers lost billions of dollars in sales. So, I'm going to be a little harsh here, but the ignorant, poorly educated MBA holding analysts on Wall Street, they were always focused on the spreadsheet models their college teachers had taught them about. How do we optimize our costs and how do we maximize the difference between our return on capital and cost of capital. And it was a big mistake because if you don't have the merchandise on the shelves, and you know this much better than I do, you don't get sales and you lose market share.
Right.
And
There was a lot of, I got a bunch of computers and data I can analyze to get to a single point, but that single point presumes that you're in a static situation, and we all know that. And then stuff happens, and then you wake up and you have a new turmoil to deal with.
I worked on Wall Street. I helped build those models, so I feel a little guilty. Now once I joined our industry, I realized those were sunny day models. What I
Right.
mean, you know what it's like, right? A
Yep.
sunny day with no wind, it's 70 degrees, everybody's happy. Okay, how often do
Yeah.
you get a day like that?
Yeah. And resilience and agility and frankly insurance cost money, and you
Right.
just have to decide how much do you want to put in and what's the risk of the downside, right? So,
Right.
what do you see in people do?
Yeah, so in 2022, then Wall Street turns on the guys. Why are you spending so much money in your supply chain? What? All right, fine. So they backed off on their plans, and then came the Houthis, right? Shooting at the ships, and now the ships have to go down around Cape of Good Hope. We're,
Right.
we're importing less from China, more from India. That shift's been in place. You've seen my charts and my data.
Hmm.
I mean, it's in the data. It's nothing I've made up. And as that happens, we have a little bit of a problem because now that the Houthis are shooting at the ships, we have to adjust our economic order quantities. Because you're going to get less certainty in your deliveries. It's going to take longer between deliveries. So, okay, whatever. So we could adjust for that. That didn't take any big change in your supply chain. However, the shift from China to India, China to Vietnam, China to West Africa, whatever, means you're going to bring more into the East Coast than you did to the West Coast. And we're seeing that in the data. So do you have footprint on the East Coast? No? Well, we better get some. So I work with some of the companies on port selection. Should I go to New York? Should I go to Baltimore, Norfolk, Charleston, Savannah, Jacksonville, whatever.
Right.
And then also you have the choice of East Coast, Gulf Coast. So we were working through that, and then Trump won the election, and he likes to use the tariff word a lot. And, come January, it was a little quiet. And then comes April 2nd, which I refer to as obliteration day, simply because of the effect on the stock market. I had to tell
Yeah.
my friends, don't take your 401k out of equities. You're not here to trade an event. Things will bounce back, so they did. And, the stock market is higher now than it was the day before obliteration. So
Yep.
we're good. But with all of that, this better than I do, the bullwhip effect of all of these tariff announcements. Folks had to pay attention to how do I get as much stuff as I can for this year into the US before the tariffs come back, or who knows what happens. Maybe it's 400% tariffs. I don't know. And the range of options they had, right? Put stuff in bonded warehouses and keep it in foreign trade zones, all the usual strategies.
Yeah. How do I protect? I'm going to trade off. I'm going to keep cash. I'm going to put stuff in a warehouse and wait for the tariff to get down so I can bring it in, sorts of stuff. Yeah.
Right. But
All,
it
all
was
of the sort of mitigation strategies.
right, exactly. But we also saw a lot of bankruptcies. You saw SCG, uh, I mean, a really high reputation regarded drayage company, and just 2 weeks ago closed the doors. So there was a lot of investment in the need for things like container storage yards and extra distribution centers, extra drayage capacity that was needed during COVID. Uh, but it hasn't been needed since then. We've sorted it out.
Yep.
And now we're seeing a lot of bankruptcies, and we've seen retailers file bankruptcy, Big Lots, right? They went under, and we don't need to go through a whole bunch of range of names, but it's tough. But everybody is switching now from, we did the best we can. We played defense for the first half of the year.
Yep.
I think the operating term now, and you and I have discussed this before, it's about tariff risk management. It's
So, I mean, let me back just a second for, you saw people put things in place for COVID and then you used the right to, which is, we kind of sorted it out. I mean, you've been doing this a while. Is this kind of what happens? There's always a disruption. We always overreact. And then we just kind of figure out how this is the new normal. We build the resiliency in place, or we take the actions we need to take. And then our overreaction sort of attenuates over time. So unless you're day trading, um, let's have a strategy. Let's walk down the hill. Let's figure out how we're going to navigate this in a thoughtful manner. Is this kind of the way things go? I mean, is there anything that's surprised you out of this in terms of this cycle versus any others?
Yeah, I'll tell you what surprised me. I just did a survey,
Uh-huh.
and I looked at it across industries, and I meant to bring my PowerPoint with the chart up here, but let's skip that. We don't have time for that. But I went through the industries from consumer packaged goods, food, electronics, automobiles, etc. And I listened to all the management consultants and others to see what percentage of companies were in the process of planning how to make their supply chains more resilient, which was what they were trying to do during COVID, but had to abandon. But now, you were a supply chain manager, and if you try to fix your supply chain when it's not visibly broken, you'll get fired. Because the minute you try something new and the learning curve kicks in and things don't work perfectly the first time, I missed a little product on the shelf and you're done. Just go to HR, get that pink slip. So right now, the word that's coming down from Wall Street analysts, however good or bad they are, from the board of directors, from the stock market is, you need to put the money into it and protect yourself. You need to build a resilient supply chain. And so we talked about a barbell strategy, right?
Yeah. Yeah. I mean, share a little bit about what that is. I was intrigued by what you see there.
We need to keep it simple. There's two things you have to do. It's a barbell strategy. So on one side, I will find more supply sources. And it
Uh-huh.
doesn't mean leave China. It just means reduce my dependency on China. Go to other places, India, West Africa, the Mediterranean, maybe Central America. The apparel guys love Central America. Okay, good. Uh, and then the other part of it is if I'm bringing stuff into the US from more places, I really need to pay attention to have more points of entry. And
Okay.
where I really get involved is helping companies who import and export in their port selection. And what I've always advocated is whether an old friend of ours always, said he got all the prizes in the port industry one year, about 20 years ago, because he invented the four corner strategy. Right. So Rick was at Target. They brought all this stuff into LA. The 2002 lockout happened. It was a nightmare. And that gave Rick the power to be able to say, we have to use more entry points. Let's go to the Pacific Northwest. We'll keep the Pacific Southwest. We'll go to the Northeast. We'll go to the Southeast. And Rick left Target some 15 years ago, but Target has also included Houston. So today you would call it a five corner strategy, for lack of a better term. And what we've seen is a lot of importers didn't do that. They tried to. I mean, some of the most brilliant friends of ours, we're still stuck with a lot of stuff coming from China, Taiwan, Japan, Korea, and all into LA. And not that LA is a bad gateway. It's a great gateway. You got 16 trains a day going out of there to all over the place in the U.S. It's fabulous, but it's a bottleneck.
Yep.
And
so this idea of it's really an optionality strategy, but it's optionality on the supply side and on the receiving side, and that gives you some agility. Now, to your point, the calculus I used to do said, yeah, but Long Beach is the cheap answer. Like it's the shortest route. I can get the best rates. I can figure that out. Let's say that was the answer. Have it deleveraging Long Beach to protect and have optionality around Jacksonville, around Baltimore. That costs me a little bit of money on the operating side. How do I got to imagine, to your point around if you got a supply chain that isn't broken, nobody wants to invest in it, and you sure as heck better not take any risks. Having that discussion inside of a company where I got to look at the CFO and say, hey, we're going to start developing real capabilities to do some things that potentially delevers the optimal situation at the time. What do you have for, help me with that discussion with my CFO, because, you and I both know the answer, which is, anything times zero, because you can't get it unloaded in Long Beach or because or whatever is still zero. But how do you help people think through that? I would imagine that people want to understand the trade-offs.
So this is where I've been professionally frustrated. I always wondered why God put me where he put me. All right. And, my career path included a long stint in derivatives.
Okay.
In derivatives trading, calls, puts,
Sure.
That kind of stuff. And you build a portfolio, but you want to make sure. I mean, I'm investing, let's say, all these insurees' money, and I got to make sure that if things go wrong, I don't lose too much capital, because it's kind of hard to rebuild things. So I would buy puts, which protect you on the downside. Not a lot, but enough to put breakers on the losses so I don't lose everything too quickly. I mean,
Sure.
October 1987, the stock market crashed, and then obliteration day is another example. But what you do is you sell a little bit of your upside to pay for the puts. So you would sell some calls.
Sure.
And if the market goes up, some of your stocks will be taken away because the calls are exercised. So you can, put a little
collar your risk.
Oh, man, you know this. So I love talking to you, John. Anyways, exactly. You collar your risk. And that's what these guys should be doing. I mean, you build a little extra capacity, but then you go to places like Warehouse Exchange and say, you know what, I got extra capacity here. And if you have small shippers who need a little room, they've grown out of the baby bean guys have now gotten so big that their garage, basement, and dining room are no longer big enough. They got to go to 10,000 feet someplace before they move on. Well, we could make our extra space available. So that's how you sell some of your upside. And on the downside, that's why you went to more locations. Yep. And I've been trying to talk to CFOs about it and explain the collar, how it works physically. And I've been very frustrated.
It's an interesting point you raise, which is because you're right. All of this stuff is when you're collaring, there's a cost of doing that. There's a mitigation on the upside. There's a cost of taking the position, but you guarantee yourself some operating strategy you can build a business around. But with the advent of technology, what I call the Uberization of the supply chain, the fact that any asset can be, sort of redeployed in an environment that technology can now enable. It makes it a little bit easier to step into those things if you've got the right mindset, if you're willing to have those discussions. And you're right, there's always the Jeff Bezos who isn't packing books out of his garage anymore, but hasn't built 500 fulfillment centers. Somewhere in between there, someone needs a little warehouse space. So that's terrific. So, Walter, as you see this thing playing out, is this sort of the new normal? We're going to wait for the next tweet and we're going to see what comes next. Is that how we all are gainfully employed? Is there a place where this settles out? What do you think's next for us that we ought to be thinking about?
All right. So you used the word or a term that I used until a good friend of mine, Jonathan Rosenthal, who is the guy who created Warehouse Exchange and also has invested heavily in a supply chain visibility company. I've been advising him for 10 plus years. I said that, and he goes, stop it. He goes, go to Amazon, go find a book on platform economics. So I did. He goes, buy it, read it. He goes, there's a dozen of them. They're all the same. And he said, what's different about this world that we're going into? There's one thing that I've always told him, and that is we're going into a world of negative population growth. There's no way in hell that I think the United Nations is correct that we'll get to 9 billion people on the planet by 2050. We've been urbanizing a lot, and the more you urbanize, the fewer children you have, because a child on the farm is extra income, is guaranteed of Social Security. But in a city, they need
extra cost.
Exactly. A car, their own room, dental treatment. You get that. And so that's one part of what's going on. The other part is, as he said, this country is ridiculously focused on big. Like you go read the Wall Street Journal, whatever Walmart says is going on, the Wall Street Journal implies that that's where consumers are doing and that's where the economy is going. Wrong on so many levels, we can't even get started. We'll save that for another discussion. The big guys are only 30 to maybe 40% of the retail sales of what the consumers buy. The rest of it is really small. So the Uberization, as you put it, but platform economics, so Jonathan doesn't yell at me, is about how do you find all the little guys who need something and all the little guys and gals who want to sell something and bring them together. So Uber is an obvious example. We got all these guys driving around who would be happy to score 40, 50 bucks to give a guy like me a ride. And so the same thing is happening in more and more parts of the economy. And, so far the big belugas, like Maersk and CMA and et cetera, they haven't figured out how to get to the guys who ship less than 100 containers a year. They've tried for 30 years. You know it, I know it. But now they could have an app that would do it. And that's where this is going. We're going to, increase the value of the small in the economy.
Right.
And that's big other change.
That's interesting. So two things. So you talked about negative population growth, the idea that urbanization will, by definition, sort of start, challenge the agrarian rural dynamics of population, and everyone's going to have to deal with that, right? I mean, less people to consume means less consumed, potentially, and then it.
Yeah.
Right. And right, the workforce that goes with it and all of the implications of that. And then this idea of tech leveling the playing field, that no longer scale and having your own platform, having your own contained assets is where it's at, but instead this platform economics, thank you for a new word. I'll use it. I'll use it. You can thank your friend. It gives us a place where it starts changing the playing field, not only enabling the growth of the little guys, but to some extent being a hedge or a potential partner for big guys who can't see them right now. I can't have a relationship with those guys, but I can have a relationship with the technology platform that allows those guys and me to share some assets, to share some capability. That's going to be an interesting place to see how that plays out. You're right. It's best left for a different discussion, but I'm intrigued by where that goes. The good news is that our fight for agility, more optionality, is going to require more capabilities, more technology that'll enable different actors in our economy to have their day. And we'll figure out where that goes. It'll be a fun ride to watch.
Exactly.
Well, Walter, hey, thank you for your time today. I really appreciate it, and for tuning in. If you liked what we had to say, click that like button and the subscribe button. We come to you as often as we can with topics we think are relevant and important from News Digest and Masters Supply Chain. Have a great day.